Hey, old dogs. I just want to take a moment to welcome a new sponsor to the show, Smart Move. Smart Move is the best way I know to protect yourself from evictions and bad tenants. Smart Move has a special offer just for Old Dog listeners. Just go to tenantscreening.com, enter code OLDDOG25 at checkout, and you'll get 25% off your next screening. That's tenantscreening.com, enter OLDDOG25, and get 25% off your next screening.
This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. This is part 2 of a 2-part podcast series entitled The Power of the 1031 Exchange with our esteemed guest, Michael Lantrip. If you haven't heard part 1, which aired last week, August 12th, make sure you go back and listen to part 1 first before listening to this information-packed conclusion of this 2-part series. We pick up where we left off in our conversation. Okay, well, let's go on this next with the. Okay, we talked about the 180 days. Was there anything else you wanted to add on that should be said?
Yeah, it doesn't happen that often, but it comes up occasionally and should be covered. Something called a related party. You cannot sell your relinquished property to, or purchase your replacement property from, or swap properties with a person related to you, called a related party, without having certain restrictions imposed. You know, you can do it, but it will place restrictions on the deal. Now, a related party is defined as your spouse, your brother or your sister, your child or your grandchild, and your parent or your grandparent.
Got it.
If it's not a person, if it's a legal entity that we're talking about, it can also be a related party if you own, such as a corporation, a partnership, LLC, trust, so forth. It can be a related party if you own more than 50% of the interest in it.
Oh, okay, I see. So if you sold your property under an LLC and you bought another one of your properties that was an LLC, if you had more than 50% interest.
Right, but this covers who you sell it to. For instance, you couldn't sell, in Section 1031, you can sell your property to your brother. It's not prohibited. But if you do, then there are requirements that both of you file Form 8824, I think it is, which is what you report your Section 1031 sale on for your tax return in the year that you sell it. You have to the person you sell it to, the related party, has to hold that property for 2 years and has to file that Form 8824 along with you for 2 years. So there's a 2-year holding period if you sell property to a related party.
Okay, but you can still get the benefits of the not having to pay capital gains.
You can, yes. For instance, if you're not selling to a related party, you sell your property and whoever buys it can sell it again in 2 months. But if you're selling to a related party, they have to hold that property for at least 2 years.
Okay, I got it.
The IRS has a different view of the business world than you and I do. They only see the people who are trying to get away with something. And in their view, there are people who are trying to set up deals with family members to transfer property from high-income, high-tax bracket individuals to low-tax bracket individuals. Personally, I haven't seen that happening, but I trust them when they're concerned that it is happening. And they're trying to take away the benefit of that by requiring the person you sell it to hold it for at least 2 years.
Got it. Okay. This one's a little confusing for me. This is about the actual receipt of constructive receipt of or control over the net proceeds.
Yeah, the rule says that you cannot have actual receipt of or constructive receipt of or control over the net sales proceeds from the sale of the relinquished property. And what this basically means is that at the closing, when in a normal sale, the escrow officer completes everything and hands you your check. You can't have that. The funds have to go to an independent third party called a qualified intermediary. That independent third party holds those funds until you're ready to buy your replacement property, and you notify them, and they transfer those funds to the title company or the closing attorney who will handle the purchase, so that you never touch the funds. You never have control over the funds, and you never have constructive receipt of the funds. And that just brings up the qualified intermediary, which I would not like to talk about very much because I have a negative attitude about them, and I wouldn't want to say anything without somebody present to defend the other side. But the QI, qualified intermediary, it's a totally unregulated entity. There are only 6 states that have bothered to put any requirements on them at all, such as bonding or insurance, but there's no licensing, no monitoring in any way. 6 states, New Hampshire, Virginia, Washington, Nevada, Colorado, California, and Maine, have at least required them to be bonded or insured, but not licensed or regulated or monitored or any way. Oddly, and that brings up an interesting point, Pennsylvania is the only state that doesn't even recognize Section 1031 for purposes of state tax law. All other states generally, in their state tax laws, do whatever the federal law does for Section 1031. In other words, they allow you to defer the taxes. Pennsylvania does not.
Wow, I didn't realize that. Man. Now that QI, so the person that holds the funds, that's what you're talking about, is that's
correct.
They're specific companies or organizations that they're not a title insurance, right? Company. They're just another entity just for 1031 exchanges.
They could be a guy operating out of his kitchen.
Oh, really? Okay, so this isn't okay. It could be anybody.
Again, I don't want to be harsh because it's not necessary. It's bad enough without me emphasizing it. But a guy serving life in prison could be a QI. That's how bad it is. The Section 1031, as I said before, is a wonderful section of the Internal Revenue Code. The only thing wrong with it is the qualified intermediary provisions. They are not licensed. They are not regulated. They're not even listed anywhere except in on websites, real estate forums and places like that.
Let's see, I sell in California, but I buy in let's say North Carolina. Where would my QI be? Would it be where I sold my property, or where I'm buying the exchange property?
Anywhere they want to be.
Oh, it doesn't matter?
Does not matter.
So you could get one that's unrelated to where the property is located, or either property are located.
Oh, absolutely.
Oh, interesting.
You see, what you need to understand is they call it a qualified intermediary. It doesn't mean it's qualified. It isn't qualified.
It should be the unqualified. It should be UI.
Qualified means that they have not been disqualified because they are related to you.
Oh, okay.
See, the only person you can't have as a QI is, for instance, your attorney, your accountant, someone who has been an agent for you within the last 2 years, someone that there is a close enough relationship or prior relationship that you might have some influence over them holding your funds. They would be disqualified because they have too close a relationship with you, which is kind of ironic because then everybody else in the world who's totally unconcerned about your welfare is now qualified to be a qualified intermediary. And those funds can go anywhere. There's no requirement. There's nobody watching.
Just be my next door neighbor, right? I mean, it could be.
Yeah. Total stranger. Mm-hmm. Guy that takes your ticket down at the subway station. Anywhere.
That's crazy.
It is.
Wow.
I've been hoping for years and years and years that they would do something about this, but they have not. Interesting that you mentioned California. California does, to their credit, actually allow the state tax laws allows use of Section 1031, allows you to defer capital gains. But here's what California does. They require you, if you, like you said, sell California property, buy North Carolina property, then when you sell the North Carolina property, California wants their deferred capital gains. And the state databases are closely enough connected with the federal tax databases that they will know about it. And you will hear from them. It's called a clawback. CLAWBACK, clawback provision. Wow. And I don't know if you've dealt with California taxing authorities, but
oh no, it's I do.
There are one or two people that I'm actually afraid of.
No, California will get taxes from. I mean, a snail crossing the road. I mean, if they could find it, they just love taxing people.
Yeah. But they provide a lot of benefits. You got to love them. But there's some situations where they have gone overboard and have had to be pulled back.
Yeah. I think in the areas of especially inheritance taxes and that kind of thing, they're just atrocious. But that's a good point. Good point. Well, let's move on to the, if we can, the claim depreciation part. That's a part kind of also I'm kind of curious about because there's different types of depreciation you can do on a property, right?
That's correct. We generally lump depreciation together as depreciation, but there's real estate depreciation, Section 1250 property, and it is the period is 27 and a half years for rental real estate. It's 39 years for commercial real estate, but that's the real property. You also have probably in that real property, if you have a 10-unit apartment building, for instance, you might have a laundry room with I don't know how many washers and dryers. Your apartments might have refrigerators in them, microwaves. All of that stuff is personal property, and So yes, there are different types of personal property.
And can't you have like accelerated depreciation? Would that apply there?
Yes, your personal property that you take accelerated depreciation on. When you recapture that depreciation, it's recaptured at your personal marginal tax rate. So you could be paying up to 37% depreciation recapture tax on the personal property that you claimed accelerated depreciation on. For instance, if you buy a 10-unit apartment building, you put in new appliances in there, and you depreciate them with the new bonus depreciation all at one time, or you depreciate them with accelerated depreciation, such as double declining balance or 150% declining balance, whatever, something other than an equal amount each period is called accelerated depreciation. Then your depreciation recapture tax is your personal marginal tax bracket tax. Otherwise, it's 25%.
Okay, got it.
But the basis in your property, and this is something that people generally turn over to their accountant to handle, but it's interesting to think about it because the property that you sell, let's go back to the $100,000 property.
Right.
You claim $20,000 depreciation on it. You still have $80,000 left in there undepreciated. And of course, the depreciation statute says that once you put that $100,000 in there, you can't deduct it as an expense from your income, but each year you can deduct a little bit of it. It's called a depreciation allowance, as you know. Well, what happens to the $80,000 that you're no longer going to be able to depreciate? You still put the $100,000 in there. So here's what happens when you buy the $200,000 replacement property. You are not allowed to depreciate your replacement property as $200,000 of property, less the lot that it's on, of course. You can only depreciate in your replacement property the amount of new money that you put in. So if you had, say, $100,000 in capital gains, you had to come up with another $100,000 to buy that $200,000 property. So you're able to depreciate $100,000 in that new $200,000 property, but you're allowed to transfer the remaining $80,000 basis from the property that you sold into the replacement property and continue depreciating that $80,000 even though you no longer own that property. It's amazing.
Wow.
Now, you can combine those two and put them all together and start a new 27.5-year depreciation schedule, but you're better off continuing to depreciate what you were already depreciating because the remaining years of depreciation are fewer. So you will recover that $80,000 quicker because you have fewer years left.
Interesting.
The form is called Form 4562, Depreciation and Amortization. And it's on the IRS.gov website. Has a real good set of instructions with it. Anybody interested should go there and look at those. And if you do decide to use that, there's something called making an election. You can elect to continue depreciating your previous basis, but you have to tell the IRS doesn't care which one you do, but you have to tell them which one you're doing. And there's a line, I think it's 17 or 27 on that form that you check a box that says election made under section 1.168 parentheses little I-6 capital T parentheses little I. It's It's called a tax election, and the IRS requires you to make those sometimes because they want to know if you're going to claim depreciation, which way did you decide to do it? Of course, you'll probably turn this over to your accountant, and he'll know he should know to do all of that anyway.
Right. Okay, well, let's move on to number 10 here.
And I include 10 here because it's a mistake. There is a mistaken belief that one of the rules of Section 1031, I read it all the time, is that the new mortgage on the replacement property must be at least as much as the mortgage that was paid off at closing on the relinquished property. In other words, some people believe that the IRS is forcing you to go out and get new debt on the replacement property, and they are not. You can add your own cash for the difference. You'll need some more money, of course, because you have $100,000 net sales proceeds. It won't be that, but we're using that as a round number. And you're buying a $200,000 property. You will need another $100,000, but you can use your own cash for that. You can use, if you want to build some equity, you can use $30,000, $40,000 of your cash. The rest of it, debt. If you have a fishing boat, you're getting too old to go out on it. It's worth $40,000. You can use that. You do not have to match the paid-off mortgage with a new mortgage. And I just wanted to throw that in because I see this listed all the time by people, and it just isn't correct. It's interesting, though, if you think about it, because if you did not put in some of your own cash, you would have to duplicate the debt anyway, because what else would you do? You're buying a $200,000 property. You've got net sales proceeds of $100,000. I mean, you would have to replace the debt just as a matter of math. But there's not a rule in Section 1031 that says you have to do it.
Interesting. Evicting a tenant can be painful and cost as much as $10,000 in court and legal fees. The best way to protect yourself from evictions and bad tenants is to screen your tenants. And the best way that I know to screen your tenants is SmartMove. SmartMove is part of TransUnion, a trusted consumer reporting agency with more than 4 decades of experience. They built an online screening service for independent landlords that delivers critical credit and background reports to you in minutes. It is a valuable tool to help you when you are trying to decide who to put into your rental property, and they can help you find your next great tenant. Only SmartMove has a credit score built specifically for rental screening called Resident Score, which can identify eviction risk 15% better than a traditional score. With the SmartMove report, you'll also get a criminal background check, eviction history report, as well as a full credit report. And only SmartMove has Income Insights, a report enabling you to analyze renter income to determine if further verification is needed. See why 9 out of 10 users recommend SmartMove, and more than 4 million landlords have used SmartMove to make better leasing decisions. SmartMove has a special offer just for Old Dog listeners. Go to tenantscreening.com, enter code OLDDOG25, and you'll get 25% off your next screening. That's tenantscreening.com. Use code OLDDOG25 at checkout for 25% off your next screening. SmartMove. Reduce your risk of non-payment and evictions. Well, let's take a look. I mean, if you're up for it, at a real life example that would demonstrate really the real power of the Section 1031. I think that would be invaluable to see. Okay, how do you apply this? Let's give us an example that we can actually see how this works.
Well, a good example, one that you can understand, I think, with round numbers, is a simplified view of a real estate transaction, and it's just intended to demonstrate the power of Section 1031 and the concept of what I call free money, and we assume that you sold an investment property and your capital gains is $250,000. We're ignoring transaction cost and assuming there was no debt to be paid off on the property, assuming that you just have $250,000 in capital gains, and that is also your net sales proceeds.
Got it.
Your other taxable income, you as a taxpayer, your other taxable income was in the $250,000 bracket, between $78,000 and $488,000, say $250,000. That puts you in a 15% marginal tax capital gains tax bracket. So we'll assume also that you're in a state that has a state tax, and without doing a Section 1031, they would collect capital gains tax. So we're assuming a total of 20% on your $250,000 capital gains, and we go from there. Your total tax liability on the $250,000 capital gains would be $50,000. Now, it would actually be more, like we talked about earlier, because if you didn't do the Section 1031, some of that capital gains would be depreciation recapture at either 25% for straight line depreciation or 37% for accelerated depreciation. But let's just assume it's 20% so we can move forward with the example. Now, if you do not do a Section 1031, you will send $50,000 to the IRS and the state, and the money's gone. You'll have $200,000 left. You can do anything you want with that because you didn't do a 1031 that imposed requirements on it. However, you can do a Section 1031 exchange and use the entire $250,000 to buy another investment property. Now, what I would like to do is break that $250,000 capital gains into two parts so we can see just what you benefit from by doing the 1031. We take the $200,000 and we set it aside and we buy one property with that $200,000. We take the $50,000 that you would have sent to the IRS but did not. We put that aside and we buy another property with that one. So you use the $50,000 as a down payment, get a $75,000 loan for $150,000, and you buy an investment property for $200,000. That's why I call it free money times 4. Your $50,000 of free money ends up being $200,000 available to you for investment, $200,000 that you would not have had if you had paid the taxes. You've got the $200,000. Now, let's look at what happens in just 10 years with that one investment. We'll assume an annual appreciation factor on the property. We can't do the income because it's too complicated, but just the appreciation, just the increase in your wealth by doing this. We'll assume a 6% annual appreciation in value for the property, although over the past 40 years, the historic annual average is 6.7. Some years more, some years less, but average 6.7. We'll just use 6%. In 10 years, the fair market value of that property will increase from $200,000 to $358,170. The first year it'll go up in value $12,000. The second year $12,720 because it compounded. Your increase in value, your appreciation in property, just like interest, is compounded. And by the 10th year, it's increasing $20,000 a year rather than $12,000. The increases goes up as the total goes up. So the fair market value of the $200,000 property has gone up to $358,170, and that's a return on investment of 79%, or a factor of increase of 179%. And your equity in the property at this point, assuming that the note pay down has gone from 150 down to 120, your equity in the property is now $238,170. And that's an increase in your equity of 475%.
Wow.
You started with 50,000. In 10 years, your equity's gone to 238,000, which is 475%. And the 50,000 wasn't even your money. It was the IRS's money. That's what I like about it.
Wow. That is a great illustration. Man, oh man.
And that's just 10 years. You're going to continue living, you're going to continue increasing, and that number just goes from 238,000 to over $1 million in 30 years, which is a reasonable amount of time to assume that you would be holding that property. $1 million from that 50,000 that you didn't send to the IRS.
Wow. Man, oh man, that is just that is pretty awesome. I think everybody needs to know and understand what the value and the power of the 1031 exchanges. Oh man, this is great information, Michael. Really appreciate it.
It's a matter of numbers, leverage, and compounding. And you can even look at what you'll have in your pocket right now. If you sell after 10 years and pay the taxes, you would still have $180,000 in your pocket, because your depreciation over the 10 years would be $65,400. And that would reduce your basis in the property down to $134,600. So your capital gains would be your true capital gains, like we were talking about before, between $200,000 and $358,170. Your true capital gains would be $158,170, and your capital gains due to the depreciation that you claimed would be $65,400. And I think we've included some numbers in the show notes here to show exactly how that will work out. One of the interesting things is when you sell this property, you would not be required to pay off the entire $50,000 of deferred capital gains, because you didn't use all of your $250,000 capital gains in a fifth of it. So you would only have to pay $10,000 in deferred capital gains. And of course, you'd have to pay 20% on the $158,170 that has accrued in the 10 years, and that would be $31,634. And then the depreciation recapture would be $16,350. So you take your net sales proceeds of $238,170 and deduct your three taxes from that: your capital gains tax, your depreciation recapture tax, and your deferred tax, and you're down to $180,186. But again, that's free money. That's what that $50,000 cash turned into in 10 years.
Wow.
And that's 260% return on investment. It's really an infinite return on investment because it wasn't your money. You made 260% return on investment on money that the IRS allowed you to keep.
Man, that's amazing. Woof. Man, oh man. Yeah, that is really, I mean, that's, and this, to me, it makes it so clear why, the wealthiest people are investing in real estate. And, the tax advantages are just part of the picture. but besides just the great things that happen with property, the fact that it's real property, it's something that's solid and tangible, and all the other benefits of real estate. But here's one that definitely makes sense for anybody that's going to be selling real estate and looking to defer those capital gains. Man.
Absolutely. And while this is a reason to do it, a good graphic reason to do it, like you were saying, you're building wealth. And really your wealth starts to get seriously high after about 10 years. Because if instead of selling this property after 10 years, you sell it and do a Section 1031 exchange, the numbers are really incredible. You defer the taxes on the capital gains instead of paying, as well as the depreciation recapture. You roll everything into another property. You use that $238,170 for a 25% down payment, and you get a 75% loan for $714,510. You can purchase a new investment property now for $952,680.
Man, oh man.
And I mean, you're talking about a small apartment building, a couple of fourplexes, maybe 4 duplexes. You're moving up.
Mm-hmm.
That $50,000 that you held back from the IRS has now become over $950,000 worth of income property, not equity, but $950,000 worth of income property in your name. That's an increase of 19 times in just 10 years. And again, it wasn't even your money.
Man. Wow.
Isn't that amazing?
Yeah.
That's why I say I love Section 1031. It's one of the reasons I went to the trouble of writing the book. I enjoyed writing it. That's probably the main reason. I just liked writing it. But I thought, some people are going to figure out how to do this, and they're just going to walk around with a smile on their face.
Man, oh man, wow. This is such great information, and am I going to get billed after this podcast here? I'm just afraid. I'm going to look at my mailbox. There's going to be this big invoice here for all this free legal advice here.
Well, I wish I could. But,
Spoken like a true attorney.
Yeah.
I wish I could.
I'm actually not practicing now, and I need to make that clear. I'm not soliciting clients, and I'm not accepting clients, and my client list is closed until I get relocated. And then, like I said before, I'm not sure what I'm going to be doing. I'm actually looking at possibility of building a mobile home park. I really, really like that as an investment, and becoming a hard money lender. Well, a hard money lender combined with a closing service where I do the loan on the property and handle all of the real estate documents, searching title, a complete package.
You do it all. You've got the tax, you've got the title, insurance, you've got the seriously, man.
And probably do the accounting on the rehab as well, and then handle the closing on the sale if it's a flip.
Wow. Man, oh man. That's pretty exciting stuff. When are you actually going to be making the move?
Well, that's another thing. I never put a time limit. I guess that's why I've enjoyed everything. I've never been under the gun. Well, I've been put under the gun, with trials and going all the way back to law school exams and stuff like that. But in my personal life, and it's just me, I say when I get it done. I've sold most of my investments. I have a couple that are still out there, and when I get it done.
That's great. That's great. Well, Michael, it has been so great having you on here. I cannot thank you enough for coming on. We obviously, made this into a two-parter because there's a lot of great information. I didn't want to lose any of it. I'm sure there's folks that are listening too that would probably be interested in, how they could find out more about you and some of your books, and I don't know, maybe even send you an email or something. I don't know if you would accept that, but just some way to find out about what you're doing.
I do, yes. I get emails quite often from people who read the books and say, in Chapter 7, does that mean I can do this or I can't do that? Or you said this, does that mean this? I get emails quite often. And in fact, I have become friends with a number of people. I said before I wasn't doing any investing. I have taken equity positions in some projects in return for providing consulting services on legal and accounting and tax matters, but not being part of the project. So I've done that. But yes, I do answer emails. I enjoy getting them. And people who read the books often email me about them. The best way to do it is go to my website. It's called Michael, Michael Lantrip, LANTRIP.com. And you'll see the books there, and you can click on, I have my bio on there, I have a contact page on there, and click on any of the book covers, and it'll take you to the Amazon book page where you can read about the book, read the reviews, do a look inside, look at the table of contents, read a couple of sample chapters, and hopefully buy it and leave me a review. I would appreciate reviews. It's getting to be a jungle out there.
It's pretty competitive, that's for sure. Oh, man. Well, Michael, this has been a real pleasure. I can't thank you enough for coming on.
You're very welcome. I've been looking forward to it, and I enjoyed it as much as I thought I would.
Oh, it's going to be great for our listeners. And I know that there's going to be information there that you can take to the bank, literally.
You can.
Well, great. Thanks. And I also just want to thank all our old dog listeners out there, too, for joining us today. I know there's a lot of other things you could be doing right now, but the fact you've taken the time to join us means a lot, and we greatly appreciate it. Please note everything that we talked about that Michael shared with us today, and I will have some PDF files in there as well. Will be in our show notes section. And again, this is a two-part show, so you'll have to go see which show notes you need to go to get those PDFs. But those will be free downloads you guys can use to learn more about 1031 and to see some of the great examples that Michael has given us in terms of just the power of the 1031. Well, that's the show for today. Just recommend to look up on our show notes to find it. It'll be under Michael Lantrip, and the 1031 exchange will be also in the title. That's it for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.